Discovery Invest. Mike Rodel is the new chief executive at Hyprop, and financial results out today for the 6 months to the end of June. Hyprop owns Canal Walk, which is probably about half of your income that you generate from your own assets, and then Hyde Park, the Glen, and the Rosebank Mall, well known in Johannesburg. On that kind of portfolio, you must have a very good idea what's happening to the retail sales at the moment. These results that you released today are good. The distribution's up 7%. Is it likely to be able to be maintained?
Look, I think it's all around what the economy is going to do in the future, but our second quarter shopper flow through the shopping centres showed an improvement over the first quarter. So I suppose a first positive sign after 18 months of pressure within the environment. So let's hope that that trend continues through to year end.
But I'm seeing in some shopping centres, the shops are closing, which you didn't. In the past, you had to pay key money. Now, in fact, you might be able to get an open space.
Look, I think it really depends about which shopping centre you're looking at. I think there's a range of product that's available. You've got your top-end super regional shopping centres who I think are still sitting with waiting lists of tenants to get in.
So this is your shopping centres, in other words?
Look, we've got a very strong portfolio, good sustainable lease profile. Obviously, that's not to say that we've not seen some recent failures. I think as the recessionary environment is extended and cash flow pressures on the, call it the weaker performing tenants within your environment come under pressure, we have seen some failures. But there are people out there looking to open new businesses, so we are, in most cases, managing to fill that space.
Are you finding that any of your major tenants are reducing the amount of space that they have?
Look, I think in isolated cases, Stutterfords, for example, I think nationally they've changed their strategy. They're focusing on the bigger footprint stores and the super regionals. So at the like of Hyde Park, they've come to us and we're looking to get out of their lease. They came to us obviously with a solution, so we're putting Dion Wyatt's store into the space without any loss in revenue and a very straightforward deal. But they're obviously focusing on their strategy in terms of what works for them. Other than that, I think that some of the national chains that might have grown a little bit too fast and maybe made a couple of wrong choices in respect of location, in these tougher times they're obviously looking to scale back. But at the same time, in the bigger centres that are more established and that are doing the numbers, people are growing. So I think there's no general trend. It's really, I think, people being more focused in what they're doing.
David, this is a stock that is giving you a 7.8% distribution, a yield of 7.8%. It is a property stock. That's at the current share price of 42.25. Slight premium to the true net asset value if you take out the deferred tax.
I think it's a tough one because it's so tied to the retail industry. 7.8 is fine because it's if you look where interest rates are, interest rates are coming down, likely to even come down further. So I think on that yield, as long as they can maintain increase in distribution, I think property trusts are starting to look attractive again. But you don't like this one,
David. Well, you just can't.
It's up to it really depends.
You can't argue with Mr. Shapiro when he's in this kind of bullish mood. It's buy anything.
I've looked at them for a long time, but I'm just starting to look at them from a yield consideration point of view. As rates are coming
great
down,
assets there. Canal Walk, Hyde Park, the Glen, Rosebank Mall.
But I don't
really
think
do
we're
better
out
than
the woods, as far as that's concerned. As far as retail sales are concerned.